So you are still losing money even though you have done all the research right, even though you have do all the analysis right, even though the market is actually trading in your favor, but for some reason you are still losing money. Well, it's probably you do not understand, or you do not take care these factors, right? You do not take care this factor when you open your position. Okay, welcome to the third episode of this brand new video series called the professional versus retail, right? If you are still new to this series, or you are still new to my channel, in this series I'm basically just going to show you what is the different approach a professional trader will take, and what is the approach that the retail trader will take, which will make them lose money, right? So as usual, remember to leave me the feedback, because if I do not receive any feedback, I will just assume that you are not interested in this kind of topic, so I will just cut off the video series, right? So feel free to tell me what you love, what you hate, right? What you like, what you don't like, right? About this series, anything, right? Now, so I just left a cliffhanger right there that most retail trader, even though they have done the research right, even though they have done the fundamental analysis right, even though they are opening their positions based on fundamentals driver, but for some reason their P&L are still in the red. Now, a very good chances is that their P&L is affected by something called the carry or the rollover, right? So what is a carry or what is a rollover, right? Now, in forex market, when you buy a currency, you automatically sell another currencies, right? This is the basics, right? This is the basics, and this is how the mechanism in the forex market work, right? So when you buy a currency, you automatically sell another currency, right? So when you are trading as a retail trader on a CFD platform, or on a future platform, right, or through your broker, when you are trading like something like Australian dollar versus Japanese yen, right? But you are someone in the US, right, and your account is denominated in US dollar, right? So if you're trading something like the Australian dollar against the Japanese yen, right? So when you don't have the currencies that you want to trade, you simply need to borrow from your brokers, right, just to trade it. And when you borrow something from your broker and you sell it on the market, it's basically called short selling, right? So if you still don't understand what is short selling, you can just go to Google, right? You can just go to YouTube and search short selling, right? Search the keyword short selling, and there'll be a ton of video on that, right? And the key here that I want you to understand is that when you short something, right, you are basically borrow that asset from the broker, right? So you need to pay interest to that broker, right? This can be in forex market, or this can be in stock markets if you're trading on margin, right? So you need to focus on two things, right? You need to focus on the positive carry and the negative carry, right? So when you are in forex market, especially when you're trading forex, you basically are receiving interest on the currency you are long, and you are paying interest for the currency that you short, right? So let's say I'm I have a long position in the Australian US dollar, right? So I'm basically long the Australian dollar, I long the Aussie, and at the same time I short sell the US dollar, right? So what actually happened in that trade in terms of the carry is really that I'm receiving interest rates, I'm receiving deposit rates in terms of the Australian dollar, and I'm paying interest rates in terms of US dollar, right? Does that make sense? Right? So you need to understand the difference between a positive carry and a negative carry, right? So a positive carry basically means that you receive interest payment from your broker, right? Because you holding the interest rate spreads. And a negative carry is simply the opposite, right? Where you need to pay interest to your broker in order to hold the position, right? Now, why this is so important is that a lot of retail trader, not just newbie, right, a lot of retail guy, even experienced, right, the so-called experienced retail guy who are still struggling, who are still not making enough money, they really don't understand this. They don't even know what is a carry trade. They don't even know what is a rollover, right? And you need to understand this, because this is basically the interest that you need to pay your broker regardless the market move, right? If you are buying a currency and it doesn't, and you hold it for a year, and if that currency doesn't move throughout the year, right? So let's say you're buying at 0.97, and the next year when you close the positions, the interest rate, the exchange rate remains at 0.97, right? Although the market do not move, although you do not make or lose any money on the exchange rate, but you still need to pay the interest to the broker, right? On the next video, I'm going to bring you to the spreadsheet, right? I'm going to bring you to the screen, and I'm going to show you the spreadsheet and basically the calculations on how you can calculate the daily interest, how you can calculate the carry percentage, and how do the carry percentage actually affect your trading account, right? So you simply need to understand that, right? This carry thing is like if you're trading on a negative carry, is really like a vampire sucking blood out of you every day, right? Because you really need to pay the daily interest, and that daily interest depends on your leverage, depends on your position size, can be very massive or can be a very small thing, but you still need to pay, right? If you're in a negative carry trade. And these negative carry trades will eventually dry up your account balance, right? And maybe you would think that, okay, since the negative carry trade is not good for me, right? Because I need to pay more interest on that. Can I find some positive carry trade? Yes, you can, but considering the current financial, considering the current economic situation globally, we are now in a very low interest rate situation, so it's very unlikely that you can find a positive carry trade in the retail world through your retail broker platform, right? So you should really take this as a opportunity cost, right? When you're trading and when you're opening and closing currency positions. And this thing and this carry trade is not just only happens on forex, right? It can happens on all markets, right? As long as you are on margin, right? As long as you are on leverage, or as long as you are borrowing the stocks, or you are borrowing the assets from the broker to short sell it on the markets, right? You need to pay your broker the interest, right? So having this knowledge in mind will help you to determine what is the opportunity cost when you're holding these positions, and how you can deal with it